Barrel rolls is the reporter thrown into the secretive world of the Forex Super Model, where nothing is as it seems. Beware the techno-monk, and steer clear of Professor Code and his two assistants. Give the senior trader a wide berth, and don't expect any sense from the risk manager.
Hello, I'm the senior trader at the Forex Super Model, and this is the Technical Issues series, part 4, Trading Forex and Time. So what we're going to look at is this sort of structure of time in trading and how it affects what's going on, and that's the basic sort of issues of part 4. So let's make a start then. So if we break down the types of trading that go on really, and we put them into a spectrum of time. So you've got high frequency trading, which isn't really relevant to most people. It's a very capital intensive technical way of trading of basically literally trades are made in fractions of seconds. So that's the shortest form of trading that we're aware of anyway. So that would be the start of the time spectrum, and then we're moving into sort of the more traditional scalping. So that's where traders are after very small moves in it, and usually within a short period of time. So they're in and out after a few pips or points, and that type of trading is available to retail traders. So that's scalping. Then you've got the big bunch of day traders who are in and out within a trading day. So and individually their trades may last anything from a few minutes to a few hours. So that's then arguably the next stage of trading. Then we've got swing traders, and you can have like a short, medium or long swing depending on what you're talking about. So that would be where we would put the swing traders. Positional traders would come next. So holding positions for relatively longer periods. Excuse me. And obviously positional traders can go for any length of time, but you know, in Forex you tend to get positional traders sort of 3 to 6 months or whatever. So, and then finally, arguably the longest term is the trend, although the trend is the trend traders obviously can mutate into any excuse me again, it's the something anyway, can mutate into any of these positions really. Well, certainly swing, and you could have a day trend, I suppose, as well. So this is where we are there. So that's on the time scale. So that's the shortest, and that's the longest. Right, and so let's move it to the other side of things, and let's look at time in terms of what most traders are looking at in terms of charts so chart time if you like. And this will all be linked in with our views on time, which are relatively different to these inevitably. So if we look at the shortest way of looking at a chart is really tick by tick. So it's a tick chart, and then you've got, like, 1 minute, 2 minutes, 5 minutes, 10. These are all the usual 30 minutes, 1 hour, 2 hours, 4 hours, 8 hours, 1 day, 1 week, 1 month, 1 year. So they're the standard spectrum of time when we're looking at charts. And interestingly, if somebody was to show you a chart and not tell you the time frame of the chart, you would be very hard pressed to know what the time frame was. So if somebody showed you a 10-minute chart and a daily chart but didn't put the time scale on it and asked you which was which, you quite often would be struggling, and we'll talk about that at another time, a bit later really. So what we're looking at then is that's the sort of spectrum of how people trade time and how they look at time in terms of charts and what have you. Now, when you're looking at the default trader, the default trader is taught a number of things with regards to time. Now, so let's clear this off. I know we keep going on about the default trader, but that's our sort of starting point really for making the models, because if we know what the bulk of people are thinking or doing, we can actually model the markets in a more constructive manner. So when they're looking at time, if you've been on any sort of course or read books or been on the internet, they quite often talk about multi-time frame analysis. And it's told to you in a way that this is superior to normal single time frame analysis. So this is more advanced in a way. This is what you're told. If you look at multi-time frames, then you're a more advanced trader than if you look at a single time frame. Now, quite often they'll tell you about the 4 times rule. Inevitably when you hear rules in Forex, you need to literally run away and give them some thoughts. So the 4 times rule is that you should be looking at basically, say, 15 minutes, 1 hour, and 4 hours as your three time frames. And it's the 4 times because 4 15 minutes are an hour and 4 hours are 4 hours, etc. So, and you can actually multiply that through on any set of time frames. So you could do 2, 4, 8, or whatever you wanted. But they're arguing that there's merit in this 4 times rule because there's a spectrum of information that can be gleaned from these different time frame charts. Now, they argue that the long time frame will tell you the main trend. So in this case, it would be the 4 hour. You'd be looking at the main trend. Is it an uptrend or a downtrend? Higher highs and higher lows, etc. All that stuff. Then the medium turn is the buying and selling bias, according to them. So this is, where we are, it's the main trend according to them. main trend. So, and this is the buying and selling bias. And the shortest time frame that you use is used for entry and exits. So that's how time is used quite often by traders. So if they're more sophisticated in their view, they're using multi-time frame analysis. They're using the longer time frames for assessing the trends, the middle time frames for the buying and selling bias, and the shorter time frames for the entries. So that gives you an idea of the status quo, really. So what we're going to do is we're going to look at our approach to time and trading, really, and some thoughts on that. So right, let's clear the decks on this and get to where we're going then. So right, now we in the Forex Super Model we use complexes. We use so a complex and a full complex would be, say, for the dollar, would comprise of 7 currency pairs. So we've got, if we're looking at the dollar, so it'd be euro dollar, dollar yen, pound dollar, and they're the core ones, and then we bolt on dollar CAD, AUD dollar, NZD dollar, and dollar chuff or Swiss franc. Right, so you've got 1, 2, 3, 4, 5, 6, 7. So that would be our full complex, and we obviously don't have to trade the full complex, but that is our full complex, and we look at the time from the perspective of futures contracts, and futures contracts basically have a 90-day. So a futures contract has a 90-day lifespan to expiry. So and they expire in certain months: March, June, September, and December. Now, the dates vary depending on what financial instrument you're dealing with, but primarily that's what you're looking at in the markets. You're looking at futures contracts that have a 90-day lifespan, and they roll over at some date during March, June, September, and December. Now that has implications for financial markets, which are quite often ignored by a lot of traders. So that's our starting point on time, if you like. So let's imagine then. Let's imagine that this complex, say the dollar complex, and obviously you can have all the other complexes. And if you're not sure about these complex things we're talking about, there's videos. What are FX complexes and how do you calculate them? Have a look on the site. It's all there for you. So we'll talk about the dollar complex. So it's made up of the full complex is made up of these 7 pairs. Now let's imagine that we've modelled the dollar complex and we know in positional terms where it is in terms of its cycle. Now what I mean by that, let's assume that the dollar complex, the full dollar complex, has a cycle rather like let's assume it's rather like a standard sine curve, right? So it just goes on. So you've got a peak and a trough, a floor, likewise, and it just goes on and on. Now, let's assume this is the modelled dollar complex. It could be any of the complexes, but if for example, if the dollar complex is near a top in our models, so in other words, the combined positional nature of these 7 pairs, when translated into the dollar complex on its own, we are in this sine wave effectively, although it's not exactly a sine wave, but it's for demonstration purposes, let's say it is. So let's assume that we're at a top, or a model top. Then what does that actually mean for these 7 FX pairs? Well, for the dollar complex as a whole to be at a top, or a model top, then the individual pairs must have certain characteristics. So the euro dollar, for example, must be very low, must be near its own personal floor. So that means the euro will be weak against the dollar, hence we've got a high in the dollar complex. And likewise, then you've got, for the dollar yen, we're looking at this situation. The dollar would be relatively high to the yen, and here the pound would be relatively low to the dollar, because the dollar would be strong. Likewise with the CAD, and there's the opposite here, it's the opposite here, and like so. So let's assume that when you look at, say, the daily charts for, I don't know, the AUD dollar, you would expect, given that the pound complex is at a point, or at a top, or a model top, then you would expect, say, the AUD dollar, the AUD to be quite weak versus a strong dollar. So the chart you would expect the price to be at the bottom end of the daily graph on the AUD, and likewise for all of these in their relative positional sense. So what you've got then is, if you just bring it all together, is that you've got futures contracts which roll over on a 90-day cycle. You've got a complex cycle which is made up of, if it's a full complex, these 7 FX pairs. And if you know where you are in terms of the model top, so you could, this is, say, the 50% halfway mark. So now, that would be a floor. So if we were at a modelled floor, obviously these would be reversed out. The euro dollar would be up to the top of its daily charts, and so on and so forth. Now this is sort of partially the one of the key tenets of the modelling, if you like, is that our aim is to identify where we are in the complex cycles for each complex. Now, if, for example, we're at this model top in the dollar, then we would know, given that the rollover cycle, say, for the futures contracts is 90 days, we would know that unless they were going to roll them over and actually push the dollar even higher, which is a possibility, and that would be part of our analysis, then the likelihood is that the organisations holding these, if they're long the dollar, they'll be in highly profitable trades which will need to be materialised, and that's the other thing, is that institutions are are judged on results quarterly, annually, etc. And they can't just hold paper profits indefinitely. They have to actually realise these profits, and in realising strong dollar long trades, they'll actually have to sell them and roll these contracts the other way and sell them out. So this is how we use time in the modelling. We use it from the perspective of a 90-day rollover on the contracts. We look at where the full complexes are in terms of positioning. So are they at a top, are they at a floor, are they mid, and then we relate this positional complex positioning to individual FX pairs on a time basis. So we really look at that aspect of trading in a very different way to the majority of traders. The majority of traders, as I said, to sum up, are looking at, depending on their trading style, are they scalpers, swingers, or whatever, then they will be using multi-time frame analysis, and they'll be using a bucket full of indicators, and they'll be talking about 200-day moving averages and buyers in control and all this stuff. And we actually have moved away from that analysis in a way on the modelling, and this is what we're looking at. We're looking at the broad brush futures contracts, which, as we said, expire in March, June, September and December. So we know where we are in terms of the time cycle, we know where we are in terms of the complex cycle, and therefore we can make sensible decisions on the individual FX pairs given the whole spectrum of information on. And if you look at the daily briefings which come out in the mornings, we're talking about what's going to knock these pairs around, and that is all done in this sort of time context. So I hope that helps, and watch out for the next video in the series. Thank you very much.